Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields, a mixed bag on Monday. Recall last week we saw 10-year note yields get up close to 290. Looked like we were going to get all the way up to 3%. That's been the target really all year is 3%. Not this quickly, but certainly a level I think that's been on everybody's calendar. When are we going to get to 3%? And we got very closer last week. This week we saw the yields kind of go up and down on most of the day. We ended right around 285. And I think right now it's waiting. It's kind of in that wait and see mode again. Recall that the treasuries have been very reactive, not only to what's happening in Washington, but also what's happening in the equity markets. And equities today certainly outperformed, I think, what we saw last week. So I think that the market's still waiting for that it catalyst that we really haven't seen. Yes, it's been a curve trade, and yes, it's been a positioning trade, and yes, it's even been a demand trade in treasuries. But right now, we're kind of waiting in that 285. Recall not too long ago, we looked at 220 to 240, then we moved that range up to 230 to 250 yield, 260 to 280, and now we're 270 to 290, and now we're kind of 275 to 295. Not quite yet at that 3% target, but it is coming, and it will be here sooner than I think most people had expected. Market volatility, yes, it's still higher. It's holding at these sustained levels, which isn't something that we're very used to. Yes, we see moments and higher spikes in volatility, but they're very short-lived. Not this time, as we continue to extend the range, the yield range that is, heading towards 3%, a level we haven't been at in quite some time. We continue to hold volatility at elevated levels, and so that's going to maintain, that's going to keep everybody at the edge of their seats. Likewise, it's going to keep the uncertainty levels very high. Obviously, when the market moves around and outside of expected ranges, that's going to bid volatility. And what do we have later this week? We do have CPI. That's going to be the focus number of the week. I think coming off the average hourly earnings number, which was perceived to have been very strong after the year employment report, CPI is going to be a key follow-up. Will the CPI number reveal inflation, something the Fed has been talking about but not seeing in tangible form for the last few years? This could be a big turn, and that's possibly one of the reasons why we've seen yields elevate so quickly. Also one of the reasons why the market may be looking to shift towards higher Fed rates in the near future. Don't forget that we did expect 2 rate hikes this year, possibly a third. Now we're kind of leaning towards 3, possibly a fourth. It's not there yet, but if you look at if you read between the lines and the tea leaves, you can see that the Fed really wants to act a little more aggressively this year while they can. If inflation goes up, that's one reason why we'd see it. So 10-year note yields still trending higher, not quite at that 3% target, but I wouldn't look away too quickly because we're going to get there sooner than later. This is Todd Colvin coming to you from the floor of the CME Group.